Welcome back to the deep dive. If you're looking for maybe a foundational shortcut into the technologies really powering everything now, AI, cloud computing, all those smart devices you own, well, you've come to the right place. Today, we're digging into one of the most critical sectors out there, semiconductors. And specifically, we're looking at the benefits, maybe the drawbacks too, of taking a diversified route through one vehicle, the iShares Semiconductor ETF, tickers SOXX.
Right. It's basically the infrastructure of, well, right now and the future. Semiconductors, chips, they aren't niche anymore. They're just essential. I mean, everything runs on huge data centers, AI training systems,
Yeah.
all the way down to your EV. And yeah, like you said, even smart washing machines. And the key thing is, demand isn't just steady. It's always demanding newer, faster chips. That pressure, it drives a lot of potential growth.
So our mission for you today is to cut through some of the noise. Instead of you trying to guess, is it Nvidia? Is it AMD? Who's going to be the winner in 10, 20 years? We're going to analyze the structure, the performance, and the trade-offs of just buying a basket of these companies through SOXX.
Yeah, and maybe for listeners who are a bit newer to this space, let's quickly define what an ETF actually is. An ETF, exchange-traded fund, it's basically a fund that holds a bunch of stocks, right?
Right.
But you buy and sell shares of the fund itself, just like you would for, say, Apple stock. It's a really quick way to get diversified exposure to a whole sector. And just for context, looking at our sources, a share of SOXX is trading around $267.61 right now.
Okay, let's get into the historical performance because this is where it gets, well, really interesting. This fund has a track record. It shows pretty robust average annual gains, especially over longer periods. Looking at the data we pulled, the trend is honestly crystal clear. Over the last 3, 5, 10, even 15 years, the average annual gains have consistently topped 20%.
It is quite a remarkable track record. Let's quickly hit the specific numbers we have. This is as of September 11, 2025. So over the last single year, the gain was 16.91%. Still good. But zoom out, like you said, and you see the power. The 3-year average, almost 28%. It's 27.95%. 5-year average was 22.42%. 10 years back, it averaged 26.12%. And even over 15 years, it's 22.65% average annual return.
Wow. Those are just staggering figures. And it really shows the power of, well, compounding a mind with exposure to a sector that's genuinely, revolutionary and growing fast. To really help you visualize what that could mean for let's say, a disciplined long-term investor, let's just run a quick hypothetical. Okay, say you consistently invested $10,000 every year into this ETF, and let's assume conservatively an annual return of 17%, which, as we just heard, is actually lower than its historical average over those longer time frames.
Right. So after just 5 years of doing that, $10 a year at 17%, your investment could be worth roughly $82,000. Keep that going for 10 years. Now you're looking at around $262,000. And if you stuck with it for 15 years, potentially, you could be seeing an investment worth $1.5 million.
That potential really highlights why this sector, especially through a diversified fund, is so appealing. But, and this is the crucial reminder, always, these numbers are historical. Or hypothetical. They're absolutely not guarantees for future returns. Past performance doesn't predict the future.
Absolutely. Couldn't stress that enough. The market changes, past results are just, well, past results. But okay, now that we understand the kind of performance it has had, let's look under the hood a bit. When you buy SOXX, what's the structure? What are you actually getting?
Yeah, what exactly are you buying? Is there a manager in there making active calls, or is it more automated?
It's passive. SOXX is an index fund. That means it doesn't have an active manager trying to pick the next hot stock. Instead, it just tracks an established benchmark. Specifically, it's the NYSE Semiconductor Index. And that index is made up of U.S. semiconductor stocks. The fund's rules are pretty clear, too. It has to keep at least 80% of its assets invested directly in the stocks that make up that index.
Okay, but I see here in the notes they allow up to 20% flexibility for things like futures, options, swaps, even cash. So for an investor who just wants that simple index exposure, why have that 20% wiggle room? Is that for taking extra bets?
That's a really good question. It gets into the mechanics of running a fund smoothly. That 20% flexibility is generally not used for aggressive speculation in an index fund like this one. It's more about practical management. The fund manager might use futures or options to handle cash flows efficiently, maybe hedge certain small risks while making sure it still closely tracks the index. Think of it as managing liquidity and minimizing tracking error, the difference between the fund's return and the index's return. Not really about trying to beat the market.
Ah, okay, that makes sense. It's operational. And another big plus for investors who want that broad exposure without breaking the bank is the fee structure. We're talking low costs here, right? Which is pretty common for these big index trackers.
Yes, exactly. The expense ratio, that's the annual fee they charge to cover costs, it's remarkably low.
Just 0.34%.
0.34%. Let's make that real. If you have $10,000 invested in SOXX, your annual fee is only $34. That's it. That kind of cost efficiency is a huge draw, especially if you're investing for the long haul. All right, so we know the performance potential, we know the structure is passive and low cost. Now let's make it really concrete. Who are you actually investing in when you buy this ETF? It recently held 31 different stocks. That sounds diversified, but let's look at the top 10 holdings. Where's the real weight concentrated?
Yeah, the list is pretty much a who's who of modern computing power. The biggest slice goes to Broadcom. That's at 9.49%. Right behind them is Advanced Micro Devices, AMD, at 8.98%. And then third is Nvidia, holding 8.38%. Okay, so boom. Right there, the top three are absolute giants, companies that have basically dominated tech news and market returns for years. Who else is in that top 10?
Our next up is Qualcomm, that's 6.04%, then Texas Instruments at 5.48%, and Micron Technology at 5.09%. Then you got Lam Research, 4.57%, Monolithic Power Systems, 4.06%, KLA Corp, 4.05%. And rounding out the top 10, Intel with 4.02%.
The numbers are impressive. The company names are definitely top tier. But wait a minute. If Broadcom, AMD, and Nvidia together make up, let me say, 26.9%, almost 27% of the entire fund, that's over a quarter. Isn't this index fund really just becoming a proxy bet on those three specific companies? Where's the structural diversification benefit if the weighting is so skewed to the top?
That is the core issue, isn't it?
Hmm.
And it's what's so fascinating and maybe challenging about market cap weighted index funds, especially in these high growth sectors. Look, the diversification benefit is there. You hold 31 different companies. They're across the supply chain, chip designers, manufacturers, equipment suppliers. So, if one smaller player hits a wall, it doesn't crater your whole investment. That's the diversification. However, because it's weighted by market capitalization, basically, the total stock market value of each company, the biggest, most successful ones, naturally get the biggest weight. And those top three, Broadcom, AMD, Nvidia, they are absolutely dominating the highest growth, highest margin parts of the market right now, like AI chips, custom silicon for cloud providers. That's where the explosive growth has been.
Right, so you're not just investing broadly in chips. You're disproportionately investing in the massive success story that's already happened with the biggest players, especially in the AI race.
Exactly. And that's the trade-off, plain and simple. You are heavily weighted towards stocks that have been incredibly strong performers, historically strong. That gives you a kind of stability, maybe riding with the proven winners. But it also means you're inherently buying more of them at their current, often very high valuations.
Which brings up a really crucial question for you, the listener, the potential investor. Do you want more wheat given to smaller companies that might have higher future growth potential but aren't market leaders yet? Or are you comfortable with the index leaning so heavily on the established dominance of these giants? Understanding that concentration, that structural tilt, is probably a key insight to take away about this specific ETF.
Yeah, it really forces you to think about your own risk appetite and what you believe about the future of these mega cap tech leaders. Is there still a lot of growth runway ahead for them? Or is a lot of that incredible growth maybe already priced in?
Okay, so let's try to wrap up this deep dive for you. SOXX clearly offers diversification across the semiconductor supply chain. It has shown historically remarkably strong returns, and it does all this at a very low cost. It's a pretty clean way to get into an essential high-growth sector without having to do the, frankly, brutal work of trying to pick individual stock winners and losers.
And just to put it in the bigger picture, while SOXX is, a really solid choice based on this data, it's definitely not the only choice out there. It's always important for you to remember the investment world is huge. There are plenty of other promising index ETFs. Some cover different high-growth areas. There are even other semiconductor ETFs that might use different weighting methods, maybe equal weighting or something else. So options exist.
Absolutely, lots of options. But the fundamental truth underneath it all seems pretty solid, given how much the world increasingly depends on chips for, well, everything. National defense, smart homes, and especially cutting-edge AI that just consumes staggering amounts of processing power. The question isn't really if the semiconductor business will thrive going forward, but since this particular ETF, SOXX, is so heavily weighted based on the past success of those top three, Broadcom, AMD, Nvidia, Here's the final question for you to think about. How much of their future explosive growth is already baked into their current massive stock prices? And what does that concentration imply for the next decade of returns you might see from this index? Something to mull over until our next deep dive.